equity strategist Georgina Taylor joins us now in the studio from Legal General Group. Hi, Georgina.
Morning.
No double dip. That's the message from you.
Yes, absolutely.
Are you confident in that call?
I'm feeling confident from an economics perspective, but I think for markets we're going to go through various phases over the next few months where we worry about double dip, then we'll think about whether we can really come through this over the next couple of years without dipping back into recession. But I think that really our core scenario is that growth is going to be sluggish for a while, but that's not that exciting to talk about. So I think people opt for the double dip camp or the V-shaped recovery.
But in an environment where growth will be sluggish, what sort of environment is that if you're an investor?
It's not great, to be honest, because I think at the index level it's going to keep markets range-bound over the next 3 to 6 months, because we'll have periods where we think that, actually economic data is rolling over, the double-dip fears will come back to haunt us. And then there'll be other pieces of data which suggest we're coming out of this. And I think there'll be an ongoing battle between different parts of the economy, thinking governments have to cut spending. Is there enough going on in the corporate sector, the consumer sector, to really pick up the slack? And I think it just won't be clear.
And you'll have days like today or yesterday when S&P downgrades Ireland and the markets start thinking, oh, sovereign debt concern once again. What's your take on Ireland?
Well, I think it's really interesting how over the last couple of months since the stress tests, suddenly the market appears to have decided that the sovereign risk has disappeared for a period of time. And I think the earnings season helped with that, and we got very bottom-up focused. Our view is that it really hasn't gone away. All these problems are still there under the surface. I mean, in Ireland in particular, Ireland was put forward as an example of how to do it. They got ahead of everyone else, and it hasn't worked because growth is very, very weak in Ireland. And I think that's a problem for all of these other countries where the coming out of the government deficits, etc., is very, very reliant on economic growth improving, and that's the part of the equation which isn't quite coming through yet.
And it leads you to the question, because as we see today, the spread between the Irish 10-year, German 10-year, record high. We aren't seeing the bond markets of Spain, Portugal and Ireland, their yields, they're not quite as high as they were at the peak concern a few months ago. But there is a lot of money going into bonds, aren't there? Specifically US Treasuries, German bonds, UK gilts as well. Bond versus equities. I mean, talk to me. How do you get your head around it?
Yeah, I mean, it's a real dilemma, I think, for equity investors at the moment, because if the bond market is truly reflecting economic growth expectations, then it's a disaster for equity markets if growth is really going to be low for an extended period of time. I think actually what it's reflecting is the search for yield. It's reflecting liquidity. It's reflecting how people are reallocating their assets currently.
I mean, you're not getting much yield in a 2-year treasury, are you?
Absolutely, absolutely, which shows how desperate it is in a sense. But I think because, QE take two or quantitative easing coming through again, is there a backstop to the bond market because of the Fed intervening? There's so much intervention going on in markets. It's very difficult to get a clear signal in terms of direction. Does
that mean dividend yields become attractive? Do we start thinking, hang on, if I get 0.5% on a 2-year treasury, let's go to a FTSE company that pays me, 5, 6, 7 times that? Well,
in terms of our view on the market being range-bound, I think the trough in markets are very much supported by the cash that the corporate sector has. I think people got overexcited potentially about how big the M&A boom would be, and I think there'll be a bit of M&A. I think people got excited about how strong CapEx would be. But actually, I think focus on dividends, focus on the payouts, and I think they'll be supported, and that's the place to be relative to bonds.
Georgina, thanks. Georgina Taylor there from Legal General Group. Right.